Joining us now is Kyle Stanford, lead VC analyst at PitchBook. Kyle, welcome. So 50,000 VC-backed companies out there now, 2 times as many as 7 years ago. They're not going public, so that money can recirculate back into the system, and they're finding it harder to raise. How is this going to end?
Right. So I think 50,000 companies is a huge data point in this entire market slowdown, right? Again, like you mentioned, double the number from 2016. We've seen a lot of capital pull out of the market. And even though there's still a high number of investors, 50,000 is a number for the US market alone. IPOs have stopped more or less. M&A is really kind of trudging through, and it's been many small deals going through. So there will be a lot of companies that we believe do end up having to sell off for pennies on the dollar or end up going out of business, right? It's not something you want to see, but with that many companies and very poor exit opportunities, that's probably the likely outcome for many of these companies.
So this bears on the public markets in the sense that the IPO pipeline eventually is filled by these companies, usually the later stage ones. So either we're probably going to see some forced M&A, like some combinations of private companies to keep them alive, or companies either have to come public or smaller companies have to die, right?
Yeah, unfortunately, that's what it is, right? And we have a model that looks at kind of the estimated number of IPOs that we should be seeing on a monthly basis, and then compare that with what we're actually seeing. It's been 18 months since the number of companies that are actually completing an IPO was above that estimated line, right? So there's a huge backup of tech companies, especially, waiting to go public. So even though Kava's had a nice IPO, there's been some small movement to S1s. We're not seeing a huge number of companies rush to market. No one wants to be the first, and there is going to be that backlog when we do finally see a market that's willing to accept these VC-backed companies.
So yeah, I keep hearing that SaaS-based companies are not able yet to get the kind of valuations that they'd want to come public in this market. But at the same time, AI startups are still popular. So are you going to see AI perhaps remain popular, but everything that's not AI and that can't go public really have a hard time?
Right. I don't want to compare AI to kind of the crypto craze of a couple of years ago, but it really feels the same right now. AI has been around for some time, and investors have been putting money to AI for years and years and years. Obviously now, with everyone being able to go on their phone and ask ChatGPT a question, it's kind of come back into the limelight. But it also checks a lot of boxes for investors, what they're looking for right now. They want their companies to be more efficient with the capital that they've had. AI is a good step toward doing that, right? You hear a lot about, AI is going to take some jobs, and it won't necessarily do that, but it will make, the mundane operations of many of these tech companies that much easier. Then the workforce can spend their time focusing on that other 50% that is much more, employee intensive, right? And it spend that much more time. So we do see this having some legs and continuing on for some time.
Looks like you're in an office, Kyle.
I am.
Are you in California? Is that still a thing in California?
Oh yeah, San Francisco. I mean, San Francisco did fall under 20% of deal count for the 4th consecutive quarter, which is definitely an interesting movement in the market. But we're seeing movement. We're seeing an increase in deal flow across the U.S., and it's not necessarily a decline in just San Francisco.